Hey everybody, welcome to Passing Notes. I'm Bob Repass, and again, I'm joined with Chaz Guinn. Chaz, how's it going?
You know what, man? 2025 is kind of an exciting time to look at the market and what we're about to step into in terms of change, both administration-wise, but also policy-wise and sentiment, right, regarding the housing market. So excited to be back to kind of talk through that a little bit with you.
Sounds good. Why don't we just kind of recap for everybody how 2024 wrapped up for us at Revolve Capital? That fourth quarter was pretty awesome.
You know, it always feels like, it's our Super Bowl time frame. I know me and you were talking about football off camera, and we were just, looking at a little bit of legendary success that Patrick Mahomes is starting to have, right? And he kind of thrives for these moments in history, as you can tell. It's almost as if, getting to the playoffs, getting to the AFC Championship, and then getting to the Super Bowl is kind of his status quo. But for us, if you look at from September through the balance of the year, that more or less becomes our playoff to Super Bowl run. This is where a lot of banks and financial firms, credit unions, community banks start to shed delinquent assets on their books before the year ends. So they start putting stuff out in the September, October timeframe for you to make an offer, and then you have a sprint to do your confirmatory diligence and then close the deal. So exciting that we were able to bring on nearly 100 million of assets in a 90-day span from, call it September-ish, through the middle of December. So here we are in the beginning of 25, kind of starting off with momentum. So.
And that was key, the momentum piece, right? Because you don't want to start any year like behind the eight ball. All of a sudden, it's like, dude, we got to go find some product.
Big
What's
time.
going on?
Yep.
Here we were able to get deals done before the end of the year, get that portfolio set. All right, 2025's here. Let's roll. And we're ready to hit the ground running. And we know there's some uncertainty in 2025, and we'll get to that and talk through that a little bit. But let's talk a little bit just about, housing prices and, what's going on in the market with the housing supply and the value of houses. And I know we had read an article recently from the Wall Street Journal that was talking about some of the institutional investors, Invitation Homes and America for Rent, and, just how on one hand, the property values look like they're really high, but then when they're putting them on their books and what the net asset value is a significant discount to what that value is. And there's a spread in there that somebody has to make up at some time, whether it's at disposition or what. So let's kind of speak to that a little bit and kind of dig in.
Yeah, I apply that to an investor that's listening to this podcast, as somebody who says, look, I'm a fix and flipper, or I buy assets to create short-term rental, or I'm able to put my eye on it and be able to buy it for a discount, fix it up, and then rehab it to churn and burn it, right? So if you're listening to that, you know how scarce supply has been. Elevated rates have kept new homeowners and new first-time buyers on the sideline from buying your potential rehab, right? And, you said earlier about momentum. Everybody listening that's a business owner understands how hard it is to create momentum, right? And so here we are with the momentum creation. It almost feels like it's a push and pull, because the macro market is keeping many buyers on the sideline that should be buying assets. But how can you afford a floating 7% 30-year fixed rate today, right? The affordability concerns really start to impact momentum, right? And so to your point about NAV and the discounts, look at house prices today. I'm sure everybody has a little fun with Zillow and the Redfins of the world of hopping on there and just doing searches throughout your own neighborhood and properties that you may or may not have been keeping an eye on, and you still see that the value is creeping higher and higher and higher. And you may be asking yourself, how do they afford that? How are they actually going to be able to afford what it would take to put down the 20% and then get the 80% financing from the bank at a 7% on this $2.5 million home that more or less should be trading around 1.8?
Yeah, that's what I was going to ask you.
1.9 million.
Just because the value says it's inching up and keep going, in reality, what is that house going to sell for?
Thank you. Is it supported?
And to your point about affordability, we have rising interest rates. And even if somebody can come to the table with 20% down and a 7% 30-year mortgage, you have to add on top of that your homeowner's insurance and your property taxes
That are all inflating.
and in some cases homeowners homeowner dues.
Exactly.
Right. So all of a sudden your payment goes from X to 3X, right? Certainly in some markets, right? I mean, we don't have to talk about, the tragedy in California with the wildfires and what the insurance state is out there. But if they were even able to get insurance on those properties, will they in the future?
Now, exactly. So even if they do this rebuild structuring, who's going to now be able to come in, afford the insurance that now backs that at that home, right, in that area? This is where this is not really being talked about. There's a lot of entrenched minutia that me and you are talking about right now, but many of the folks out there are feeling this. However, it's not making the headlines, and this is why we brought up this article that's showing on the Wall Street Journal regarding net asset value that's being slashed. If investors or institutional partners are starting to slash value, what happens to the owner occupant out there that's trying to sell their home that's unable to do it? Right. So if institutional guys are doing it and the occupants in the houses are the ones typically last to be able to take that haircut in price, this is where a little bit of the stall is starting to happen from saying, look, the price is just too high. We can't afford to kind of bridge the gap that it is required to buy that asset. And so
right. And the homeowner has that catch-22, right? I mean, they want to sell their property, but where are they going to go? Right? Because if somebody like myself, I have a sub 3% mortgage for years, right? Even if I downsize, I'm going after a new home, right? With a rising value and a high interest rate, right? So what are we going to do?
Thank you.
And a lot of people are just staying there, which is causing a supply issue. So, you have to take a look at it. It's like, when does the new generation of homeowners decide they're not going to be homeowners? It's easier for me to rent. Why do I need to worry about the insurance and the taxes, and just roll it into my rent, and my rent will be up a little bit higher, but I don't have to worry about it. So I'm afraid we're going to see a decrease in home ownership just because of the affordability problem.
I think that's a concern and a fear that has been priced in. And I don't know if it's been priced in enough, because if we're talking about discounts to value, this is becoming because the investor or the buyer that's going to be taking somebody's house off market is not your first time. It's not your millennial, right? It's an investor, right? And it's not somebody that's downsizing looking to pay up for this rate environment that we're living in, right? So a lot of this chatter is talking about sentiment of, well, look where we're going with the administration. Look at inflation beginning to get tamed. This is all optimism that I don't want to damper, right? We should have some optimism as to where we're going as a country, where we're going as a real estate market. I couldn't be more excited about the direction of the country. However, a lot of this housing supply issue that we're talking about has kept a lot of the stagnation going. Here at Revolve, we have this revolution effect that we create on purpose.
Right.
There should be this flywheel method to what you're doing. When folks want to come in, they want to understand what type of properties they could acquire from you. They could be in North Carolina, and all you're showing them is Texas. Well, we don't buy in Texas. We're in North Carolina. Well, why don't we start showing you properties that get you to a fix and flip? Sounds like you guys have been doing that for 20 years. This is where we feel like firms like us, we're not the only ones. There's many out there that are in this market that are creating a supply chain increase, right? Because we all know that the minute you see a well-priced home that pops up on your home in your market, goes pretty quick if it's priced right.
Exactly.
Now, we're talking about rates, so it's a little bit contradictory. But if it's priced right, and we're starting to see sellers baking in rate buy downs to get the house sold, right? So let's just say rate, for example, doesn't become an issue, right? So what do they say? Date the rate, marry the house.
Right.
So if you do in fact though get a buy down from the seller, and you start getting yourself into a property and it's priced right, that's because it's going so quickly and velocity wise because there's little supply. So why don't we chat a little bit about the different loans, right? Now keep in mind, everybody that's listening, is we do in fact buy loans, but they're collateralized by a residential home. And at times, people stop paying on those loans. And if they do, in fact, stop paying on the loan, then the house, in fact, does come back to us as the investor or the lender. And we now have to strategically figure out, how do we dispose of the asset? Do we want to liquidate it through a rehab? Do we want to liquidate it through a potential rental? And now our strategy becomes, our design, which is an exciting part about the business, which is why we feel like we are really bringing change to a market that needs supply. Because today we're not seeing the supply, and we're starting to see in the capital markets area, a lot of supply is getting shown out, but it's not making headlines.
Right.
It's not making your article news of Wall Street saying, here's where supply is coming from. So let's give them a little bit of taste as, from the HECMs, from RPLs that then go into a delinquency and stop paying and start becoming a non-performing asset that we eventually have to take back.
Right. So our focus obviously is distressed debt. And that can be broken down to various asset classes, like you said, right? It could be non-performing loans. It could be HECMs, which is home equity conversion mortgages, commonly known as reverse mortgages, right? And to your point a minute ago about housing supply, boots on the ground, local markets, fix and flippers, how does a fix and flip investor find inventory? How do they find product, right? And the reverse mortgages is a key to help them fill that niche in certain areas, because you have a house where the borrower is now deceased, the property is vacant, most likely needs some work done on the house, right? And if you can secure that house, possibly work with the heirs to shorten the timeline so that you can get that property back, you are able to turn that house back into a home in that neighborhood. And that fix and flipper can either fix it and sell it, or he can fix it and sell it to an investor and turn it into a rental.
Options.
Right? So our play on the reverse mortgages is how can we help build home ownership, and if nothing else, stability in the neighborhoods if it is a rental.
Big time. So let's speak to that a little bit. If you're a baby boomer or older, right? So if you're at the age of 62 to 65 or older, and you now have started to take on your equity and be able to flip the script and use your equity to repay down your mortgage. And many are starting to understand that this HECM, this acronym, is becoming here to stay, and it's not going anywhere. And what does that really mean is there's at least 1 million plus units that are not only in the GSEs, but are throughout banks throughout the country. So sounds like a lot, but in relativity, it's not that many, right? There's 83 million plus active mortgages across the 300 plus million people we have in this country. So million units across 83 is less than 10% of the actual volume, right, of the product. So, or plus or minus 10 to 11%. My point there, though, is if those homes are sitting vacant and they're in communities throughout the country, and investors are the primary buyer of that product, and it's all it needs is a facelift. We're talking light rehab, carpet, paint, mow the darn lawn, clean up the roof, get it to a position where it's going to attract a first-time home buyer, right? This is where a lot of this supply is not being shown out on major platforms like, your .com seller that's out there. Anybody can Google a major seller that's putting product out there. These are not going to be floating on those sites. This is why we're trying to kind of educate the listener, saying, look, HECM is here to stay. It started showing itself in the market about a couple of years ago. There were about 2 loans to 3 loans out of every 10 that were kind of being circulated in the market. But hey, now they're starting to be 4 to 5 to 6 loans out of every 10 are getting traded out there. Now, what's the play? The play is to get to the real estate, Bob. It's to get to what you were talking about, a fix and flip, a rental, a buy and hold, a buy and short-term rental. Right? This is where we're starting to say, look, that's 4 different ways you can buy a home today and exit it profitably. Dude, walk me through that. I'm not seeing those sort of strategies just walking in the market that we get to invest. This is why we're kind of still on fire 16, 17 years post 2008. Right? Still buying this type of stuff, saying we want more liquidity. We want more of you to get into the damn space because you didn't know about it.
Well, like you said, a year and a half, 2 years ago, people started talking about reverse mortgages, and everybody was like, I don't really know a whole lot about them. And even if we had this conversation 9 months ago, it would have been like, okay, there might be a play there. Now people are really starting to see, okay, this is a way that I can get to that property. On one hand, if it's a non-performing loan, a non-HECM, which they oddly call a forward mortgage as opposed to a reverse mortgage, who would have thought? there's other resolutions that you can do to keep that person in the home.
Sure.
Right? You mentioned reperforming loans, RPLs. Right? You can do a mod, keep the borrower in the home. Right? You can do a forbearance plan. They could go to the state and get a housing assistance funds, bring their account current. But on a HECM, the borrower is deceased. Right? The property is going to be sold, whether it's by the heirs or by the lender who forecloses on it. Right? So our number one strategy is to try to contact the heirs, work it out where we can get a deed in lieu, shorten the time frame, because everybody knows time is money, right? And a vacant house doesn't appreciate while it sits there and goes through the foreclosure process. How do we get our property in the shortest time and make it right with the heirs? So that's our strategy going there. And then how do we contact and get in front of the local fix and flip investors, right? And how can we get that property back to a performing asset in that community? Paying the property taxes,
Impact.
paying the utilities, keeping it from being a vacant property. We all know what happens in your neighborhood if you have a vacant house, no matter what kind of neighborhood you live in. If somebody down the street all of a sudden moves out and the house is vacant and the grass isn't cut for a while, everybody goes, hey, what's going on down the street here? You know, that's not good for me if the neighborhood started having vacant properties. And that rolls all the way through to the city and the county and everybody else. So we feel like the HECMs not only are a good investment for us, right, in our fund, but also for the community and for the local investors and for the people that are going to occupy that home once that home is rehabbed.
Look, we got it down this rabbit hole, so to speak, is because this is what we're kind of calling the frozen housing market. This is where you're starting to see supply is not coming to market from a traditional retail sense. You're not seeing a ton of new builders building new homes, right? Cost of supplies and the ability to be able to churn and burn what value home, right?
Well, to your point a minute ago on the building, I mean, they have to offer rate buy downs to sell brand new houses.
Thank you.
Right? The builders out there, oh man, I just built 10 spec homes. Right? I don't know who would build a spec home in today's market. I mean, it's got to really be in a great...
Those things are sitting.
Right.
You and I both know that that's why the frozen housing market to us says, what house is selling? When are we going to be able to jump in? Because we all know that if you look at the data, 8 out of every 10 mortgages today, the homeowner has a sub 4% rate on their house. So who is going to want to race to get out of a 4% and then jump into a 7%? You and I both know that needs to be flirting around a 5 to be able to help entertain that conversation of, do we exit? Do we sell and get that equity and roll it into a new property? But this is where I appreciate the HECM space, because the HECM says there's a way for supply to no longer be as scarce as it is. If we're talking about 1 million units, let's just say half of that comes and makes its way to the market. What would that do? That's an additional 40-ish thousand of new units coming to market every month.
Right.
Right? And that 40,000 being extrapolated throughout the U.S., you're telling me you wouldn't feel that in every community? Damn right you would.
Right. And it's funny because when we first started learning more and more about reverse mortgages, the tagline was, it's the only mortgage that was created to default, right? Because it's due upon death of the borrower.
Sure.
Right. So every reverse mortgage that was made knew the outcome. Now, you didn't know how long the borrower was going to live, right? Somebody could live to 90, somebody could live to 68.
Yep.
Right? So you didn't know how long that timeline was, but sooner or later that reverse mortgage is going to get to that default, right? Unless that property was sold prior to that person dying.
Yep.
Right? So you have 1 million units that at one point in time are going to get into this position where borrower is deceased, property is vacant. What are you going to do with it? And the GSEs, to your point, that own most of these assets do not want to be in that business of going through the whole foreclosure, the whole rehab. They want to sell those loans when they're ready. And right now they're selling them on a quarterly basis, right? HUD is putting out auctions every quarter.
Exactly.
And what are they, 2,500, 2,800 assets a pop?
Correct.
Right, every quarter. So they're moving 10,000 of them a year.
10,000 at 300-ish to 350,000 a home, right? So do the math, right? They're moving billions of this on an annual basis, and little do you know, are you reading about that sort of avenue in your daily news? So this is where we want to be able to bring kind of a different angle to what you're hearing, what you're reading, because we're in the market today. Right, we're a $100 million firm that's growing. Our goal here this year is to cross the $400 million mark in real estate acquired. How are we acquiring all that capital? It's coming from capital markets. It's coming from delinquent loans. It's coming from major financial institutions. It's coming from tier one banks, folks that you guys have an ATM card in your wallet from. A lot of these guys are originating trillions of dollars of real estate on an annual basis. And obviously, naturally, billions of that will go into default on an annual basis. It's only a fraction of the book. And where's that billions of delinquency going? It's got to go out into the private sector and folks like us that are providing liquidity to major institutions out there. So this is where we really kind of root into, what does 2025 bring us? And we did start kind of smelling a little bit of uncertainty.
Well, I wanted to bring that
Right,
up
so-
because you were like, oh, we're optimistic about 2025 and what's going on. And I was going to say, well, there is still a little bit of uncertainty, right? And it's funny. It's like we have a new administration in. It's been, not very long. And, the price of eggs are still $4. There's no change. I'm like, come on, man. Let's get realistic. But to that point, rates aren't going to drop in a day. Right, we're not going to get that 5.5% rate when we're still over 7%, right, in the next week.
Sure.
It's going to take some time. So there is some uncertainty as far as, all right, well, how much impact are we going to have as far as getting these rates down? Because to your point, on top of the affordability of the down payment, plus the insurance and taxes, it is rate driven. Right, your P&I payment is going to be, it's a 30-year mortgage at that rate.
But if you're not a cash buyer today, that monthly affordability overhead is a factor. Let's just be real about this, right? So yes, if you're not putting down all cash to take down the house, then of course your monthly payment is the main driver if we're going to stay in our situation or if we're going to move. And the reason why I think I can continuing to smell uncertainty is because there's an inverse relation to we saw the Fed dropping rates in the latter part of 24. We still imagine more rates are going to be coming drops, but we're not seeing the relational fact of those rate drops happening in the mortgage arena. So because of that, how long do they stay elevated? And my guesstimate is they're going to get well into 25 before we see any meaningful change to rate. I think this is a 26 discussion. I'll be the first to kind of, be a little bit of a less optimistic of how fast rates will come down that will affect your ability to jump into the housing market. I think that we're into 26 before we start really seeing a cyclical change of buyer behavior. That being said, when we talk about 2025, I say there is things to be fired up about. There is meaningful change that are going to be happening to policy and less regulation that will allow a lot of investors and a lot of folks to jump in. I think we bring an alternative investment angle for a lot of the community across there, and they're going to say, look, if stock market's doing this, we don't know what the macro trends are going to be. Where can I put capital? Where can I put dollars in an asset-backed investment that has been here, not going anywhere, and has been able to kind of withstand headwinds like COVID, withstand administration change, withstand rate change,
Inflation,
affordability, all these buzzwords that kind of get made up right there on your phone. But to the point is, where can I put capital that's giving me meaningful return? That says, look, I'm hedging myself against what I'm seeing in the macro market.
Right.
And this is why I think you and I get fired up about kind of bringing the message to the mainstream of saying, look, rates are one thing, affordability is another, but how long will that kind of persist? Dude, I don't see any meaningful change that's going to happen in 25 that's going to start changing buyer behavior and get people in the market.
Let's talk a little bit about the opportunity, because we focused so far a lot on the distressed debt from a HECM perspective, right? Which is getting to the property, turning that property back into a home. From the standard non-performing loan, we're seeing in our book a lot of assets that we are able to get into a reperforming stage, right? A lot of these borrowers are realizing, whether it's because of the rates, the affordability, whatever, they have no place else to go. They need to figure out how to stay in their home.
Sure.
And whether that's through loan mods, government assistance, whatever. I mean, we have seen a significant uptick in trial loan modifications, keeping the borrowers in their home, right? And let's kind of walk through, we make the borrower, put some money down, put some more skin in the game. We analyze their financials so that we end up giving them a payment that they can afford going forward and to get them up to date. And a trial mod is usually done on a 6-month basis, sometimes 12, depending on how delinquent they were, to make sure, for lack of a better word, they're going to stick, right? Like they're going to make this and they can afford it. And if so, it converts to a permanent mod and they keep making their payment. We have a reperforming loan that, from our investor standpoint, now we can look to retrade to somebody as a performing cash flowing asset. What is your take on the number of loan mods, forbearance plans, the trial mods that we're doing? Do you agree that we've seen a huge uptick probably in the last 9 months?
And I think it kind of sticks with the theme of where they're going to go. And because there's a lack of supply, and because they've been able to build up quite a bit of equity, I think they're in a position to say, look, are we going to sell the house? And then are we going to go rent? And where are we going to go rent? Right? So I do think that the behavior has definitely changed from 10 years ago to where we are post-COVID. That being said, I would say 3 to 4 loans out of every 10 that have a real viability for a mod, right? Keep in mind, they've come into the behavior of not making a payment for 1, 2, up to 5 years.
Yeah, it's funny because you're evaluating a loan to do a modification, and their payment is, let's say, $900, and you're going to do a loan mod, and the payment's going to be $700. And so, they were paying zero. So their payment's technically going up, not down, because they were paying zero for 2 or 3 years.
But let's stick with borrower behavior. I haven't made a payment, even of $900, to use your example, of 3 years, 4 years. And now I say, look, I do have a little bit of cash to put as a down payment, and I am going to want to stay here in this home. But we need to help retrain the behavior, right? We need to be able to see that month in and month out, you'll be able to make your on-time payment. What that starts showing is the viability of where the borrower wants to be, and they're able to say, look, I don't want to wake up in cold sweats 90 days from now saying we can't afford this payment any longer. That tells us that homeowner needs to move, right? Because the payment is now outweighed the risk of staying put. That being said, we are seeing far more conversion from a data perspective post-COVID than we did pre-COVID. Okay, because today the average asset that we acquire is an equity protected, non-performing loan. Okay, let me say that a little differently. 10 years ago, we were buying underwater homes, right? $100,000 home, they owed $150,000. Today, we're buying $150,000 homes and they have a $75,000 loan balance, and they're not paying.
Right.
So they're sitting on equity, still not making the monthly payment, even though they have all the strategy in the world to just stick a for sale sign in the property, pay us off, take the equity, go rent for a little bit, and get their life back on track. Does that happen? Very rarely, if you believe it or not.
And I think it's back to, where am I going to go? Right? Because it sounds easy. Oh, sell your house and go rent somewhere. Do you know what rents go for now?
Elevated.
Right? Probably as much or more than the payment they couldn't afford anyway. Right? So why give up that equity? They need to go ahead and get back on track, to your point, which, to see whether or not they're going to make those payments, is the reason why we do the trial mod, right? We don't want somebody to wake up 90 days down the road and go, you know what? I can't even afford this new payment. Then we have the conversation of selling your house, doing a deed in lieu. What can we do to help you, right? We can help you sell that house, get your equity out. And if they have some decent amount of equity, finding a rental property with a bunch of equity, cash in hand, makes it a lot easier for them to transition out of the house that they're in into a new home.
Sure. Bob, we need to give the crowd a little bit of an understanding that there is a high amount of liquidity in investors and buyers that we talk to in the open market. So imagine we try a strategy with a homeowner who hasn't made their mortgage payment for a few years. They don't take our call. They don't take the servicer's call, of course. We can't get them to understand our strategy of keeping them in the home. Right? Financially, we've explained this to you before, but it's far more economical to keep folks in the home and making steady payments than to have them go into foreclosure. However, foreclosure is a profitable exit and a good one. But if you can do an impact by keeping folks in the house and be able to potentially even have them refinance you out and you're paid off at par when you bought that exact loan less than a year ago for a discount, you could see the economical impact both as a win for the homeowner and win for you as an investor. But I want to just kind of like root down a little bit into this is a remote-based, internet-functioned, servicer oversighted business that allows you to remain as passive as you want to be. You can be as active as you want to be, right, but allows you to be hands-off. We deal with so many folks that are coming away from being hands-on with their real estate projects, right? Whether they're coming from the commercial world, the multifamily and apartment world, syndicating funds, or even doing their own rehabs on apartments. They're doing their own fix and flips, trying to be their own Chip and Joanna Gaines, thinking they could be the next hit and have their $800 throw pillows in the lobby for you. But I joke, but
it's the shiny object syndrome, right? They can't decide what their investment is, so they hop around. To your point, apartment syndication, that was hot for a while. Self-storage buildings, that was hot for a while. Senior living, that was hot for a while, right? Student housing, that was hot for a while, right? And then all of a sudden, well, let's go back to non-performing loans. That treated us pretty well.
Thank you.
Right?
Yep.
I finally got my money out of that apartment project. Maybe not all of it, but I got most of my money back out of that apartment project. What am I going to do with it now? Another one? No. I kind of like that non-performing, right? Or I like that cash flow.
Yeah.
Maybe I can put a portfolio. Maybe I'll invest in a fund that has a nice, steady, return that I can count on every quarter. I don't need to be so active. I don't need to get my hands dirty and do my own rehab anymore. I just want to be a passive investor in one of the capital funds, right? And we have a lot of folks that do that, and then all of a sudden they'll say, you know what? I want to buy one or two of those loans myself, right? Do you have anything in this particular area? Oh, yeah, I got something down in Houston. Okay, well, let me see it. And then all of a sudden they play around with one or two of the assets directly.
Now you add a little bit of tech, you add some automation, you bring your CRM and your marketing into the world, and before you know it, you've got this business in a box. You're overseeing a servicer who's interfacing with homeowners. If you're a lien lord out there, or a landlord, we like to call it, you're sitting there with a bunch of rentals. Say you got 5 to 10 rentals, and you're interfacing your property manager each single month, collecting rents, having to deal with water heater breaks, having to cover those costs. And the reason why we like the lien lord is because when you start introducing where our market is finally starting to catch up, right? We talked about this many years ago where, our industry is far behind where Amazon is in their industry, right? The logistics from being able to make a quick purchase from your iPhone and to have that thing show up on your doorstep same day, right? What we're starting to happen in the real estate world, as soon as, DocuSign got introduced and you started having real transparency into buying and transacting with real estate, right? When I can be able to get a contract, I can be able to make the offer. I don't have to physically do all these things. I can have it done digitally. Right. And so what we're starting to see now when we talk about all these different strategies, whether you're a cash flow person, whether you like to get your hands dirty, but you can oversee a crew that can get their hands dirty, I think this is kind of the angle we're trying to bring from an educational standpoint to say, look, if you're trying to look at residential backed assets, we're not commercial. We're residential backed assets. We feel like that's the fabric of what created this country in the first place. Land, and then land on acquisition was grown to residential. And that's what they keep quoting the American dream, right? Is to be able to come here, pursue your ability to grow what you want and how you want to do it, but be able to really have a family, a good looking home, a car that you really like, a different house, a different business, whatever your appetite may be, right? This is still very much alive, but it's being done now in a different fashion. It's being done where you passively can manage a portfolio nationally, locally, multi-state, region specific. Kind of doesn't matter, performance based. I would tell you, if you're getting into notes and you've never bought a mortgage note in your life, you should probably look at buying cash flowing assets, something that you can create your own mailbox money with, right? Something I can say, look, we have 123 Main Street in Nashville. It's making an $1,100 payment each month. They originated the mortgage in 2015. It's got a 30-year run on it, so it doesn't mature until 2045. Still has 20 years left on it. That's something that you can sit there and say, look, I can buy that at discount and then collect the payments until the loan matures or I get paid off. Sheesh. So this is the type of angles we're starting to say, look at cash flow. But if you are an investor, guys that we're seeing every day today, we saw in 2024 when we took a house back after it got foreclosed on and then either went back to us through auction. And now we have to get a local crew there to lock and secure the property, to get it completely trashed out. When we then would put that asset back on a market, a first-time home buyer was not our buyer.
No.
The rate environment kept that frozen market participant on the sideline. This is where we started to see investor sentiment and investors coming into the space. And this is where we're starting to see institutional investors really taking an earmark at the book of assets that is being sold. You mentioned American Homes and an Invitation, which are sitting on 60 and 80,000 assets respectively on their portfolios. Those are billions of assets. Do you feel, being around the market, seeing as many different cycles as you have seen in your career, do you see the institutional investor continuing to take slugs, even though we started to see regulation and law coming out that's going to forbid them from taking a bigger slice? But do you think they're going to kind of step aside on that regulation and be able to still take market share, or do you feel like that will temper down a little bit as kind of the 25, 26, and potential new Trump era takes over?
Well, first of all, you have the media and a lot of folks where the institutional investor, the institutional landlord is the big bad guy, right? They're keeping people from being homeowners. They're buying up all the properties. I'm not 100% sure that's the case. I do think they're shifting from their current model to more maybe of a build to rent. They'll build to rent a community. In other words, we're going to do a subdivision. 50 houses, they're all going to be rentals. But their ultimate play is value appreciation.
Sure.
And that goes back to how we talked about at the beginning of net asset value, right? They're saying the house is worth 420, but on the books it's like 340, right? When you add in all those costs we were talking about,
right.
The carrying costs, the capital costs, your homeowner's insurance, your taxes, all those fees that all of a sudden that property is not worth 420. Right. So they will ride and hopefully that property will appreciate. We're going to sell it to a homeowner. Well, the homeowner can't afford it right now. So they're going to be stuck with that property in their rental book. So that's what they're going to end up with. So one thing I wanted to just piggyback real quick, when you were talking about technology and how you can manage your book of business all across the nation, right? Look, everybody has their comfort zone where they want to invest in their own backyard. Right? But sometimes you live in a backyard that's like really sexy, right? You mentioned Nashville. Mm-hmm. Nashville has been on fire for a long time as far as property values, right? So what you could buy 5 years ago, not so much these days because of the price increase. You have to be able to manage your investment to where the best opportunity is.
What's that mean
right?
to you?
So is that Chattanooga, Tennessee? Is that Memphis, Tennessee? Is that Knoxville, Tennessee? Some other market? Because, you like Tennessee, you want to be there. Well, you don't have to be in Nashville, right? Same thing, everybody, I want to be in Dallas. I want to be in Austin. I want to be in San Antonio. Sometimes you got to move outside of that. Sometimes you got to go to a state that's not as hot real estate value-wise as a Florida, a California, an Arizona, a Washington. So the point is, with the technology you were talking about earlier, you're able to see those opportunities. You're able to manage those opportunities. You use vendors like loan servicers that can stay on top of that borrower, keep that mailbox money coming in. And if something goes sideways and you need to foreclose, or you need to look at doing some kind of workout resolution, you can rely on the servicer to do that. You sit back and make the executive decision on whether or not which path you want to go down.
You and I both know 5 years ago, this was BS. This was not an ability in the business because tech hadn't caught up with what we were asking the data to tell us. There was so much manual keystroking that was happening throughout your system that less and less of it was automated. You fast forward to 2025, and a lot of this now is starting to be not only automated, but the data is starting to tell you behavior. And the more you can understand behavior, the more you can avoid leakage of time. You and I both talked about time value money in this space really starts to leak out profits. When you buy something at a discount and that discount starts to continue to sit on your book for longer and longer, the discount is less and less and less to market value. Time and value, you've got to churn and burn. This is hence the name Revolve Capital, right? Pun intended there.
And one thing we haven't talked about, and we can save this for next time, is the impact of AI and how that's going to impact the technology piece. Because you can't, I know it's strange to open up a newspaper. Nobody even opens up a newspaper anymore, but you can't go online and read an article and somewhere it doesn't talk about AI, right? Whether the stock market's up or down because of AI companies, whether or not AI is now being introduced to the loan servicing world, to the doc prep world, all throughout the due diligence process. To your point, it's like, how can you forecast borrower behavior? And AI is going to become more and more of a factor in that. And if we sit here and have this conversation a year from now, we're going to be going back saying, you know what? When you mentioned AI before, look at how we've grown in the last 12 months.
We've had some fun with this, but I'll kind of bring an image to the listener. Is imagine the movie The Beach. It's with Leonardo DiCaprio. So if you haven't seen the movie, it kind of the premise of it is he found himself a private island, and it was created and given to him from a map. And they took the map, followed it to a T, and got themselves to a private island. I do feel like this market does present you an opportunity to get into a private secret island. And I drive that point simply to say that this arena has been around heavy and kind of was created since 2008. A lot of this market was not available for you, the listener, of being able to jump into this space and buy onesie-twosies or create your own portfolio from scratch and really create wealth through buying assets at a steep discount. This market was not here in 2008. So from 2008 till today, this market's really been able to mature and bring tech to the space that it can allow it to behave and act like every other industry that you're operating in today, whether it's construction management or not even real estate based at all. So to the point about AI and machine learning, what we're starting to see, to your point about doc prep, is even the title space, is if you take an entire collateral file of full documents, 200 pages of documents, that now can be scanned in AI in a matter of seconds, where that would take a manual person. If you guys all remember those little thumbs you'd put on where you're physically going through pages, gone are those days of manual any of that, right? Where that now can be kind of turned over. So it allows you, right, the person listening to say, what an interesting space, man. I've heard of notes. I didn't know technically how to get in or who I'm going to get in with. And this is why the company was created. We created this company to say, look, we can open a door for not only banks and large aggregators of delinquent assets to be able to offload that to a sound, viable firm that's been able to have the track record to do it. But then who else can come underneath us to say, look, I don't have hundreds of millions, right? I've sold my restaurant. I've got a little bit of cash. I've got $100,000. I've got maybe less than that. And I want to kind of look at to see what you guys have. You guys couldn't go to the doorstep of major sellers and buy for your own consumption. This is where we've created this bridge, right, for you to get into the space. So haven't you seen just in the last 5-6 years the explosion of this AI, this machine learning, this ability where it's applicable now, right, to our space? It wasn't applicable, right, to what we were doing. So I bring up the applicable stuff because from a financing standpoint, and from rates staying high and supply remaining low and values getting cut by institutional investors, we feel like all of those headlines allow us to kind of stay under the radar. And I think gone are the days that we want to stay under the radar now. I think we want to start kind of stepping on top of the rooftops and screaming as loud as we can to say, kind of come and learn about the space. We're not the only ones doing this, but we feel like we've created a really good niche for you to come in and feel there's a consistency of being able to see well-vetted institutional product that you would not see that's off-market and that's being bought at a steep discount to market value or par in terms of the loan balance.
Right. Chaz, as always, it's been great sitting here having a conversation with you, and I hope the listeners like that. And if you do, hit the like button, hit the subscribe button. And also, if you want to learn more about what we talked about, whether it was the reverse mortgages, the cash flowing RPLs, non-performing loans, you can go to trade desk at revolvecapital.com, or you can go to our website, revolvecapital.com, and learn more about it. Hit us up on the email, and we'll be glad to show you some product. And we look forward to hearing from you. And until next time, Chaz, it's been great.
Cheers, brother. Thank you.